Well, so far this week's sale of 2-year and 5-year securities have gone well with pretty strong demand. Now, Tom Tucci is head of U.S. Treasury trading over at RBC Capital Markets. He joins us now from New York with a preview of today's 7-year auction and a wrap of what we've learned so far this week. Welcome, Tom.
Thank you.
So I just want to get your take in terms of what we've seen so far. Talk to me a little bit about your reaction.
Well, in general, you have to realize that the story has been unfolding for a couple of weeks. 2 weeks ago, when Chairman Bernanke talked about the fact that the Fed was going to be on hold for much longer than people anticipated, the front end of the market had to readjust to that. Up until about 3 weeks ago, there were some people speculating that the Fed would be withdrawing some of their stimulus and even moving towards somewhat of a tightening bias moving into the new year, and he made it clear that that wasn't the case. So the front end of the market repriced itself. And what's happened since then is that we've seen from our real investors, our real money investors, an extension that's moved out to into the 5-year note. So we expected the 5-year to go well yesterday. To be honest with you, it actually surpassed our expectations. But nonetheless, there's been a pent-up demand in that area. At these real levels of interest rates, with 2-year notes yielding 75 cents, the 2-year note at 2 1/8, 225 is a relatively good value. Today's 7-year is a little bit of a different story. It's not the natural investment bullet point that most managers look at. Most managers are benchmarked usually against 3- and 5-year securities. Globally, it's 10 years. The 7-year, as you mentioned earlier on the program, is more tied to the mortgage market. And this security, we do expect some central bank demand today. However, this is an issue that depends a lot on professional traders arbitraging it and real money thinking whether it's cheap or rich on the curve and whether they want to extend into that area to pick up some value. So this one's a little bit dicier. I don't think the market unfolds on this, but there is a chance that that concession that's coming in the market today may lead up into the auction and guys can get a good purchase price.
Tom, let's talk about some more concession. Actually, the survey just came out about 2 basis points higher, so it looks like the market could move higher in terms of yields. But let me ask you about this commercial bankers, and the commercial bankers are buying in treasuries. Obviously, that's where the glut is in terms of the loans and what's going on with the loan market not coming from the Federal Reserve and then out into the consumers. Are you seeing increased flows from the commercial banks?
Absolutely. It started really happening in June, and it's been coming forward ever since. And just what you mentioned, these commercial banks aren't making loans. They have a significant amount of cash in their reserves, and they're deploying that cash in the treasuries. And as we stated earlier in this conversation, it's starting to move out the curve. I mean, 75 cents on the 2-year note is not what people are looking for a real dynamic return. So they're more than happy to move out into 3-year notes at 1 1/4, 5-year notes at 2 1/8 to pick up that incremental yield. As long as the Fed is tied into the fact that they're not going to be moving rates any higher, they're tied into unemployment, they're tied into the fact that inflation isn't an issue, that will continue to keep rates low in the medium term.
Well, Tom, I wanted to ask you, we also had headlines today of another auction of 3-month as well as 6-month bills. I mean, do you think that we'll continue to see strong demand for treasuries?
Yes, I do. I mean, particularly going into the year end, the bill situation is a completely different dynamic. Actually, bill supply has actually been removed from the market for various technical factors. But the bottom line is there's a lot of investment managers that have money in cash that has to be deployed or has to be invested before year end. And what they've been doing is they've been buying bills, just getting, it doesn't matter if they get a return, they just want a return on that capital, and they're just parking the money up front. So that's been a whole different dynamic in the front end of the yield curve. But it has spilled its way into the 2-year note, and it's making its way out the curve. So that's another supportive point for the marketplace as well.
Thanks so much. Our thanks to Tom Tucci, head of U.S. Treasury trading at RBC Capital Markets, as well as Brian Liu.